This past week, the CFTC, or the Commodity Futures Trading Commission, made headlines by making their fourth attempt at passing into financial law position limits on 25 commodities, derivatives, and futures contracts. Financialized proxies that most often dictate price discovery for real physical, monetary, and precious commodities such as gold, silver, crude oil, coffee, or sugar. The CFTC yesterday proposed commodities position limits of up to 25% of the deliverable supply of each commodity. We'll get into what that actually means, perhaps for the COMEX silver market in a minute. But this latest CFTC move was mandated by U.S. Congress's Dodd-Frank Act law passed in the year 2010, and they've failed various times in passing it over the last decade. The reason for why courts threw out past attempts is likely shrouded by the very real fact that major financial institutions and commercial banks have been filing lawsuits and stonewalling these ongoing position limit efforts. Limits on market concentrations are not in the interest of those entities who constantly make large derivative gambling profits, often allegedly conspiring together at times. Sometimes so concentrated in their market-moving powers that they can have the ability to move commodity and derivative market prices easily, and thus profitably trade them while scalping often smaller, dumb money speculators on the other side of many futures contract bets. While this latest news should theoretically cap the number of contracts that a single entity or participant on the COMEX NYMEX might hold in an attempt to prevent speculators from causing unjustified price swings that impact U.S. citizens and global consumers of real-world goods, one has to do a simple cursory look at the fractionally reserved COMEX silver bullion warehouse market to see that JP Morgan has become dominant there since 2011. They are now custodian of over half of the entire COMEX silver registered and deliverable bullion pile. To us, it remains unknown as to what percentage share of this silver bullion is their clients or what is in their house account, but there's also another unknown. Is this dominant physical COMEX silver warehouse position now going to be in violation? Or is the CFTC going to be told to pound sand yet again by the most systematically too big to fail bank of the land? If you've been following the silver bullion market, you might recall that a former multi-year CFTC Commissioner Bart Chilton admitted last year in 2019 to Chris Marcus over at Arcadia Economics that JP Morgan's precious metals trading desk was at one point the holder of an intensely concentrated silver futures market contract position, dominating spot silver prices by holding some 40% of the silver futures market share after it had taken over Bear Stearns' bankrupt silver trading desk in the spring of 2008. That year, the spot price for silver went from $21 an ounce, falling to below $9 an ounce by late 2008, during the very bottoming of the global financial crisis. All this while at the same time, the global physical and U.S. silver bullion market was being overwhelmed by real physical silver bullion demand. It was common then to see multi-month delivery back orders, silver bullion dealers with no silver inventory to sell at all, and product price premiums for many silver bullion products nearly double the then quoted live silver spot price. The same spot price mainly being derived by the COMEX silver futures market, which again was supposedly back then and somehow claiming to still now be regulated by the CFTC. Yes, I'm sure I sound cynical here, but the CFTC is the same supposed regulatory agency which, after 5 years of investigating the COMEX silver futures market from the year 2008 until 2013, decided that its investigation was closed due to not finding any wrongdoings, only to have the U.S. Department of Justice in both 2018 and 2019 obtain multiple guilty pleas by former commodities traders who allegedly illegally price spoofed all four major precious metals futures markets and front-ran their very own clients over at JP Morgan Chase between the years 2009 until 2015. Today, we're not only going to dig into this bullion and precious metals related news, but we're also going to look back at the very foundation of this now 45-year-old federal agency, called most of the time by its acronym, the CFTC. Hello, I'm James Anderson of SD Bullion, and we are about to cover a verifiable fact regarding COMEX gold futures contract exchange conspiracy and the U.S. Treasury going back to late 1974 cables. That was the year before the CFTC was put in charge of regulating the very derivative market that, along with the opaque and highly leveraged LBMA, still majority discovers the price for physical gold bullion across the world. We're about to hear a little news clip. It was done in 1973 regarding the re-legalization, in quotes, of private gold holding that occurred at the beginning of 1975 And after the clip, we'll dig into the details of the WikiLeaks interception of the U.S. Treasury cables regarding a conspiracy that went down in London in late 1974.
The Senate today approved legislation officially devaluing the dollar. Among a variety of riders attached to the bill is one that would let Americans own, buy, and sell raw gold, which has been prohibited by law since 1934. The increased price of gold in world markets has already had some impact in this country. ABC's Dick Shoemaker reports from California.
So, thanks to WikiLeaks' interception of U.S. Treasury cables from late 1974, we now have learned that some of the underlying motivations for the simultaneous origin and starting of gold futures contract trading on the COMEX, it occurred around the same time that private gold bullion buying was re-legalized for U.S. citizens at the start of 1975. Again, if you go read the cables, you can find them if you go to URL sdbullion.com/gold-prices-1974. You can go and read them by scrolling down, and basically what it essentially says is that there was a meeting in London with the major gold dealers, and the gold dealers' expectations that they dictated to the interests of the U.S. Treasury was that a formation of a sizable gold futures market in the United States would be so significant in proportion, and physical trading would be minuscule by comparison. Basically, the expectation was that large volume futures dealing would create highly volatile market, and in turn the volatility and the price movements gyrating up and down would diminish the initial demand for physical holdings and most likely negate long-term holdings by U.S. citizens. See, essentially what the U.S. Treasury was concerned about was, hey, the fiat U.S. dollar is devaluing heavily, and now gold bullion is going to be re-legalized. We need to scare the hell out of Main Street from ever thinking that they should save gold over fiat U.S. Federal Reserve notes. And essentially that's what's being spelled out here if you look and read between the lines. There was another cable where it basically said that they did not feel, the London gold traders, that on the whole that U.S. citizens were psychologically prepared to switch from small-scale gold coin purchases to large-scale and long-term bullion holdings if there was, enough volatility put in that market. So essentially what you have here is potential efforts to help tame the rising market gold price via the COMEX's new gold futures contract market. And it worked. If you go look in the 1975 gold price action, 1976 gold price action, it looks a lot like 2013 gold price action, except this one, this go around has been stretched a lot more because we have more derivatives than ever. Last time we didn't have as complex a system to elongate and procrastinate what's the inevitable comeuppance for what we've done to our financial system. But back then in the 70s, they lost control. Eventually, by the late 70s, the gold price in US dollar terms or in fiat Federal Reserve note terms, it got away from the monetary authorities. All you got to do is go look at the 79 gold price rise and early 1980 gold price rise. And remember, back then, Federal Reserve Chairman Paul Volcker, he was, later he said essentially gold was something that he looked at first thing he looked at when he walked into his meetings with his staff. It's even on record that he stated back then gold was the enemy. And so it was at the beginning of 1975 that the CFTC was put in charge of regulating the COMEX gold and silver markets. And my contention is that the CFTC is not here to essentially make things fair. It's almost been subverted in the last 45 years to serve the interests of the powers that be in the commodity markets, and essentially the large financial institutions and trading houses, which make huge amounts of currency by winning trades and by dictating and dominating price discovery. So this cynicism that I'm giving across with the CFTC, it goes all the way back to its very founding. It's born in inequity, and you could just read it there with the U.S. Treasury cables, wanting to deter U.S. citizens from owning constitutional gold coinage versus the fiat Federal Reserve notes that they keep cramming down our throats. And so this week, the CFTC's head went on to Bloomberg News to do a public relations campaign on their effort.
Position limits. Finally, we get this rule and this vote expected in the next 24 hours, anticipated to pass. What exactly does it do?
Yes, so great question. So first of all, speculative position limits were something that Congress passed 10 years ago as part of the Dodd-Frank Act. And the goal essentially is to not allow people that are coming in to our markets purely to speculate. They're not hedging anything, to get positions above a certain threshold. And the reason we're putting them in place is to prevent things like corners and squeezes. But they were never meant to focus on anyone who's actually hedging. And so prior proposals didn't sort of get that right. And so we have really focused on American agriculture, the energy sector, to make sure that if you're going to these markets and you're actually hedging risk, you can do so.
Given that presidential candidate Michael Bloomberg and Bloomberg LP's financial success is much in part thanks and due to the overfinancialization of our economy, I would never expect Bloomberg's Kevin Cirilli to follow up by asking Heath Tarbert, the current chairman of the Commodity Futures Trading Commission, if the current CME Group's COMEX NYMEX Central Bank Incentive Program is going to fall under these new speculative limits too, or will the current and coming approved foreign central banks or their appointed trading desk be exempt from these coming statutes? After all, what business would a foreign central bank have in high-volume discount trading, COMEX and NYMEX derivative contracts, if not for sheer price movement reasons? Well, let's go back to the highlights of the CFTC's public meeting this week. I sat through 3 hours of it. We'll try and crystallize it here for you so you don't miss out on the most important points.
This meeting will come to order. This is a public meeting of the Commodity Futures Trading Commission. I'd like to welcome members of the public and market participants, as well as those on the phone or watching via webcast. I'd also like to welcome my fellow commissioners, Commissioner Quintens, Commissioner Benham, Commissioner Stump, and Commissioner Berkovitz. And I guess I am guided by, in this respect, by Clint Eastwood, I'm reminded by that perennial question, "You feeling lucky, punk?" And so when I look at this opinion from the district court, what's the best way? Because look, at the end of the day, we want to get this done. Congress clearly mandated something. We can argue about what it mandated, but it clearly said, look, at the very least, it said, this is important. There's excessive speculation. It leads to all sorts of bad things like corners and squeezes. And we compel you within, 9 months, it's been 10 years, but we compel you within a period to take a look at this and put position limits on these sorts of things. Again, using your discretion as an agency and all of your ample experience.
To be fair, most of the people in that room are well-meaning, hardworking people. We wish them the best of luck in their duties. And I'll leave a full link to that CFTC meeting in the show notes in case you care to go hear the current 5 CFTC commissioners and various lawyers stumble over semantics regarding the largest commodity markets they have proven themselves to be incompetent in regulating as an agency just this past decade alone. To finish this week's update, 1/2 year ago, Dennis Keller, President and CEO of Better Markets, who on June 25, 2019, sat before the U.S. Senate Committee on Agriculture, Nutrition, and Forestry in a hearing entitled The State of Derivatives Markets and Perspectives for CFTC Reauthorization.
The only thing I would say is I think Mr. Bart has referred a number of times to the volatility in the markets, and there's a lot of factors going into the volatility. There's a lot of factors going into price, none of which am I an expert on. But one thing we do know, there's excess speculation in these markets. And we need a strong, robust, effective position limit rule so that we can try and get these markets back to serving the constituency they were created for, which is the actual physical purchasers and producers of commodities. And we have a financialization of these markets where there's excess speculation across the board. Better Markets did a study a couple of years ago that showed that if you go back a couple of decades, speculative interests in the markets were roughly 30%, and physical traders were roughly 70%. That's now flipped. Speculation is now 70, this is a rule of thumb, roughly. You look at different markets, it's different, obviously. Rule of thumb, roughly 70% spec interest, 30% actual physical producers and purchasers in these markets. Any reasonable look at these, you can see there's excess speculation. That's affecting prices. That's harming the ability to hedge. That's driving up the cost to hedge. And it's causing the loss of credibility and faith in some of these markets. And I think the CFTC needs to get the position limit rule done right, and done robustly so that we can get these markets back to serving the people that they were created for, intended to serve.
Remember the stakes here. They're larger than just past, present, and potentially future precious metal bullion values. Physical commodity producers and purchasers grow the food we eat. They generate the power in our homes. They manufacture the very vehicles we travel in. They produce the fuel we need. And otherwise, they directly enable modern life. And they also help raise their standard of living, not just for U.S. citizens, but for billions of people around the world. It is not overstated to say that commodity markets are essential for every man, woman, child, and business in the USA and again around the world. But excessive speculation and manipulation in the commodity markets can contribute to seismic instability in our financial system, and it can also debase the very credibility of who we claim to be. This is where position limits come into play. They are critical to preventing excessive speculation and larceny in our financial markets. That is all for this week. If you enjoyed this content, be sure to give our video a thumbs up. If you're not subscribed to our channel, do that. And finally, be sure to hit the alert button so you don't miss these market updates as they come along. Give us your comments below. Let us know what topics you want to see more coverage on.